And the Fed wraps up that two-day policy meeting, and the government releases new data showing the impact of the coronavirus outbreak on the economy at the start of the year. I do now want to bring in economist Stephen Moore to talk more about the Fed meeting and the GDP report. Hi, Steve. Thanks so much for joining us today.
Hi, good afternoon.
The Fed chose, of course, to hold interest rates steady near zero today as expected, but they did give some more details about those previous emergency rate cuts and then their plans for the future. What were the big takeaways from today's statement?
Well, I think the Fed has been pretty much on target with respect to helping in this, hopefully once in a lifetime crisis that we're seeing right now. If anything, I would argue the Fed needs to provide more liquidity into the economy. There's a much more dangerous threat of deflation in the economy right now than inflation. Now, I know that might surprise people given the fact that we have put so much liquidity in the economy. But if you look at the prices of oil, prices of commodity, consumer prices, almost all across the board have been actually falling, not rising. And so the Fed has taken some extraordinary action, but they're probably going to have to do more to get more dollars into the economy because everybody in the world wants dollars right now. That happens anytime you have a global economic crisis.
We also got some pretty grim data from the Commerce Department today. U.S. economy contracting nearly 5% annually in the first quarter. That was steeper than expectations. What could this mean for the second quarter and the future recovery later this year?
Well, the amazing thing about that statistic that came out today was that through the end of February, so through the second month of the quarter, there's 3 months in a quarter, obviously, the economy was growing at 3%. So think about that. For the first 2 months, we were growing at a little over 3%, and then for the whole quarter, we fell 4.8%. That means it was at least a 10% decline in GDP in March. We're probably seeing at least a 10% reduction in GDP in April and probably into May. So this has been a very, very, very sharp contraction. This is what happens when you put millions and millions of people out of their jobs and when you have millions of businesses that are failing or cannot operate. So I don't think we should be too surprised about this. The real question now is, can we get this economy up and running? Arthur Laffer and I have a study that suggests that by the end of the summer, we could actually have a decent recovery. But it really depends on when these businesses start reopening, because as you know, it's very dispersed between the states in terms of some opening up and some staying closed.
Ahead of this downturn, the consumer was really what was driving the U.S. economy. We were shifting into a more consumer-driven economy.
Yeah.
The Conference Board's Consumer Confidence Index did plunge this month, as expected, of course, but the survey did show some optimism for the future. More consumers saying that they do expect conditions to improve over the next 6 months. How important is that as we look toward a rebound?
Well, obviously, consumers can't spend if they don't have a job, right? And they don't have income. And that's why, and by the way, consumers also can't consume if businesses aren't producing things to consume. So it really begins with getting businesses up and running, getting workers back on the job. I do think over the next 3 or 4 months, we're going to start to see a recovery. I think consumers may be a little optimistic that they can just start going out back into the society over the next 2 or 3 weeks, and it's just going to be like it was before the crisis, and that's not true. We've lost so many businesses already. Businesses are going to be slow to recover. And I also worry, by the way, that a lot of workers will not go back to work right away because the federal government is now paying them in 30 states. The federal government is paying many workers more money to stay unemployed than to go back on a job. I can't tell you how many employers I have talked to who have said that they are worried whether they're going to be able to hire the workers back that they need because the government's paying them more to stay off of the job.
Real quickly before I let you go, President Trump has been talking more about a possible payroll tax cut instead of more stimulus checks. Why would that work better for the economy than just sending out stimulus?
I'm a big advocate of that. I mean, imagine what that will do for growth. If you give every single worker in America, including you and me, a 7.5% increase in our paycheck, and by the way, even minimum wage workers would get that 7.5% increase in their paycheck starting immediately. And then employers would get a 7.5% reduction in their payroll costs. So think about what that would do in terms of the incentive to hire more workers. If we want to get workers back on the job, and we want workers earning more money and spending more money, no better way to do that than the payroll tax cut. And by the way, that means the money never gets to Washington in the first place. It stays in real America on Main Street, and that money gets pumped right into the local economies that really need it.
All right, economist Stephen Moore joining us to talk about the economy amid the coronavirus outbreak. Thanks so much for coming on the show today, Steve.
Thank you so much. Have a great day.
You too.
Want to see more videos like this? Click on the link below and subscribe to One America News on YouTube. And call your cable provider and kindly demand that One America News is added to your lineup. Call and subscribe today.